This is Shared Accounts with CU Times. I'm Michael Ogden, Editor-in-Chief at CU Times. When looking at the credit union auto loan space, two broad reviews of the situation come to my mind. One, this isn't too bad, or two, it's a big bag of lemons. As of late, though, the dual auto lending reality has felt like being forced to pick your favorite movie, but when your two choices are between Jaws 3D and I Still Know What You Did Last Summer. Ugh. Dennis Quaid, Freddie Prinze Jr., we expected better things from you. Anyway, we are spending this first month of the year focused on auto lending and not terrible sequels. On today's episode, we're going into the credit union auto loan trenches to hear what's happening with the CEO you should get to know. Welcome to Shared Accounts with CU Times. With me in the virtual studio today is Michael Powers, President and CEO of Garden Savings Federal Credit Union over in northern New Jersey. Mr. Powers, hello. Thanks for coming in.
Thanks for having me on board. Looking forward to the conversation.
Oh, I am too. Let's set the stage kind of in a few words. How would you characterize the auto loan situation at Garden Savings FCU right now?
Slower than it was a couple months ago, but still very steady. We've been actually very lucky with compared to some of the things that we've seen out there in the industry. We've got a good steady volume of auto lending right now.
That's great. So let's pause right there for a moment. I want to tell everyone that this episode of Shared Accounts with CU Times is sponsored by Cox Automotive. Cox Automotive is the world's largest automotive services and technology provider, connecting 22,000 dealers with more than 1,600 lenders and 220 aftermarket providers, fueled by the largest breadth of first-party data fed by 2.3 billion online interactions a year. Cox Automotive tailors leading solutions for car shoppers, automakers, dealers, retailers, fleet owners, and lenders. The company has 25,000 employees on 5 continents and a family of trusted and connected brands that includes AutoTrader, DealerTrack, Kelley Blue Book, Manheim, Next Gear Capital, and V Auto. To learn more, visit coxautoinc.com. That is COXAUTOINC.com, or connect over on X/Twitter at Cox Automotive, or catch them on Facebook and, of course, on LinkedIn. Okay, into the trenches, auto loans. Let's jump in. So, Michael, Garden Savings Federal Credit Union, you're a $427 million credit union with more than 25,000 members out in Parsippany, New Jersey, right?
Correct.
Right. Okay, so let's talk about what Garden Savings has been offering to your members as it relates to auto loans.
Well, really, I think we have a pretty standard platform of auto loans in that we have, your standard used cars, new cars. We go up to 7-8 years on some, depending on the borrower and the term. But we also did really well last year with a lot of lease buyout stuff. And we had a big run last year on people that were refinancing hybrid type vehicles and Teslas and things like that. So we did really well last year in that category too. But really our product is a standard auto loan, pretty good rates, very good rates, I'd like to say. And we do offer a 0.25% discount off those rates with any automatic payment, such as an ACH, whatever the case may be.
Okay, is that for new members or current, existing, anybody?
Current, existing, new, all the above.
Fantastic. So how long have you been leading Garden Savings?
I guess it would be about 369 days now. So yeah, I started January 1st of last year as the CEO. I've been here at this credit union though for almost 16 years.
Yeah, so let's talk about that. You also led the marketing and business development efforts at the credit union, yeah?
Yes, I was chief sales officer in charge of marketing, lending, and business development.
All right, very good. So let's talk about marketing for a bit. In the years you've been at Garden Savings, how many years did you say?
Almost 16.
How has your marketing strategies, how have they shifted as it relates to auto loans? Or has it?
Yeah, it changed significantly over the years. I mean, the focus of it. We're pretty lucky around here. And I know looking at the questions that we had talked about, we're going to talk a little bit later about our dealership network. We've been pretty lucky around here that we haven't had to do an awful lot of marketing because our programs are very successful. And so the programs are kind of self sustaining, and we've done the vast majority of our marketing on auto loans via word of mouth because we've got a good reputation in the regions that we focus our lending. Beyond that, I would say that, when I first came here, there was some focus on auto lending as far as doing a lot of paper and postcards. And then it really switched to a lot of digital marketing on it. We were doing a lot of digital stuff. And now it's kind of a hybrid of both. It's both digital and paper when we do marketing on it.
Yeah, so think about that 15, 16 years ago. What? We didn't have EVs. We didn't have hybrids, really. Maybe they were just coming onto the scene. When those type vehicles started to come into play, did that shift how you had to think?
A little bit. Just we weren't sure what our place would be in that market. We weren't sure, how credit unions were going to fit in. But as it turns out, some of those vehicles were financed at higher rates and things like that. So once you get one or two members organically, when we say, hey, refinance your vehicles here, if you've got a new vehicle, you can refinance it over here. Once you start getting that marketing out and a handful of people take advantage of it, and they start telling their neighbors and things of people in their neighborhood that may have similar vehicles. And yeah, so it wound up doing the work for us in a lot of ways.
So, what do your members want from you for their auto lending experience?
I think ease is a big piece of it. Speedy approvals. That was one thing that we've really spent the greater part of the last decade on, is really working on getting people approved quicker and letting them walk out the door. People that wanted to sign electronically, doing that electronically instead of cross-selling our gap and warranty programs right in person. We can cross-sell them later at closing when we're doing it via DocuSign and other things. So really, I think the rates were always good here. So the rates were never a problem. I think the biggest thing was always about speed and convenience and getting the loan in their hands quicker.
So, let's talk about the speed for a second since you brought that up. Like, what was the speed, in quotes, 15, 16 years ago?
It was hours, if not overnight, if not days. Now we've got it down to a system where we can usually get the approval within 5 minutes, really, and we're not using any of the systems out there that people are probably familiar with, Origence and Cuddle program and things like that. I mean, not that there's anything wrong with those programs; they're great, but I would say that we kind of mimicked the speed at which they were able to do things and created our own little program that works very well for us.
All right. So we were talking about what members want from you. What do you feel like you're giving them?
I think we're giving them a couple things. Number one, I love the fact that we're community based, right? We have 4 branches: Parsippany, Newark, Dover, and South Orange. Other than Parsippany, which isn't as much as a community where we're in, the other 3 branches are very community focused, and we've got dealerships that we work with in each. So the people that have a trust with the credit union then know the dealers that we're willing to work with, which we vet very carefully. And vice versa, the dealers that we work with send people over to Garden Savings for their auto loans. And so I think the fact that we're able to get them their loans quickly, often much better rates, almost all the time, much better rates for people with credit scores that might not be super prime.
Right.
We're able to get them much better rates. Right now I was just talking to our Dover branch manager earlier this morning, and she was telling me we've got a lot of refinances of auto loans coming through here with people paying 24 to 26%.
Whoa.
And yeah, and they're going to come over to us and wind up, they're not prime paper, so they're going to be in the 13s, 14s, but that's a lot better than 24, 26.
My God.
Yeah.
That's insane.
Yeah. 24, 26%. And she showed me a stack of them on her desk.
Yeah, that's like a ridiculous credit card rate.
Yeah.
So I'm looking at your site right now, and you are offering 585. Is that right?
Yeah, as low as, yep.
As low as, there you go, legal. So how does that rate compare to if you look back during the pandemic?
Oh, it's higher than it was during the pandemic years before the rates were rising, but really not that much. Some of the economists out there will tell you that credit unions were a little bit too slow to raise their loan rates, which would be an entire another podcast. But we did do that kind of on purpose because we didn't want to sticker shock our members, jacking the rates up 2 or 3% at a time.
Right.
So while it wasn't the most profitable way to do it, which is what the economists would tell you, we didn't want to sticker shock the members that are used to coming to us for the lowest possible rates.
Okay.
So we gradually increased them over time. They probably went up about 2% in total.
Before we move on to kind of this next segment, I want to reverse back to your comment about the refinancings that are going on. Can you talk about that a little bit more, what you were hearing this morning?
Yeah, just, again, that people are really the captive lenders. And it's really not even so much the captives like your major ones, because they're primarily dealing in the prime paper space. But the other lenders out there that are, I don't want to name them by name, but there are other lenders out there that are just, they come in low a lot of times and say, hey, we can beat your credit union's rate. And they do that for a couple months and try and get a couple of dollars worth of business from our auto dealerships, and then they wind up jacking up the rates tremendously. And so the people put the loans with this other company, and then they wind up refinancing with us a couple months later anyway. And the dealers say, I didn't know they were going to do that. And it kind of goes through the cycle like that. But that's fine with us. We don't have to get the loan the day of. If we get the loan a little bit later on, that's great.
Yeah, very good. They sound like the Spectrum Internet of lenders.
So you're not afraid to name names?
No, I'm not at all. Okay, let's talk about new and used right now. New and used auto loans. What has been doing the best for you and why?
Used auto loans by far, I think primarily because of that refinancing number and the fact that the dealerships we work with are all used vehicle dealers. We don't have any relationships with new vehicle dealers because they have their own captive financers. And so we tend to get, new cars 10,000 miles or less we consider new. So when we get new vehicle loans, often they're people that leave the dealership and realize they can get a lower rate. They already bought the car. They put 1,500 miles on it and say, can I refinance it over with you? And that's typically the majority of the new car volume we get. And that is a fraction of what we get compared to what we do with used car volume. So used car volume for us has been tremendous. Okay.
So your membership is focused on the used car side, it seems.
Yes. It's probably in 2023, I'd say the used was probably 85% of the volume, 80 to 85.
Well, what you are saying is reflected in the data we're getting from CUNA, NCUA, whatever. So that's very interesting. I wonder how much to kind of put you on the spot for a second, how much of the used car price has gone up in your market?
For a while there, they were going up quite a bit. I would not know the percentage off the top of my head, but for a while there, we were getting concerned at how quick they were going up because obviously, nobody likes to talk repossessions or anything, but the value of your collateral, when the car prices go crazy and you're loaning out at X dollar amount of loan to value, you could be upside down quickly on your collateral. And so, yeah, they went up quite a bit. They've flattened a lot lately, which has us a lot better. They've been pretty flat for a while now. So we're pleased to see that the increases have they came down a little bit and now they've leveled off quite a bit.
So you mentioned your auto dealer network. Is it only in New Jersey?
It is only in New Jersey. We have about 25 dealerships in it, all local, all in our 2 counties that we're in, Morris County and Essex County. We actually have a couple contiguous counties that are nearby. But yeah, we've been working with them. It was a program that we started, which is quite frankly probably way too complex for a podcast, a brief time here. Actually, the year before I came here, we started it with 1 or 2 dealers like 17 years ago. And it's a recourse-based program where the dealers have a stake in the game, which is why we're able to do so much of the aggressive subprime lending in that space. So it's a program where there's contracts involved and everything else, where the dealers are working with us on recourse on the vehicles. And again, we work with about 25 different car dealerships in these areas. Some dealers, it doesn't work for. They start seeing a few too many repossessions and whatever the case may be, and they just start saying, this is not a profitable model. However, most of the dealers that are in it and are committed to the program and manage it right winds up becoming very profitable for them. And obviously, the credit union loves the loans.
Yeah, absolutely. I was in a Volkswagen dealership a while ago when I was leasing a new car, and they brought up the relationship with the local credit union to some other customers that were in the store. And I just kind of whispered, it really works. They looked at me like, hey, weirdo, get out of our conversation. So anyway.
But yeah, we've had this network for a long time. We've expanded it. We've had dealers come and go from it. And we've had dealers that, quite frankly, have caused a loss here and there over time. But we know that there are some risks with this. But we really measure our program by A, the satisfaction of the customers that we give loans to, and B, we look at it, the net yield to the credit union after charge off, because there are some charge offs. So, but that's why we're able to aggressively lend in the subprime space.
In an upcoming episode of this podcast, we are talking about leasings, and one of the keys to it appears to be this auto dealer network relationship. So that's, I think, very interesting. I want to ask very quickly, how did you build those relationships? Did they seek you out? Did you seek them out?
It started, the very first one was where a dealership in Newark reached out to us, and our at the time he was our CFO, now he's our COO. Nick, he went out there and met with the dealership numerous times, saw how they do business, and they came up with this program, and then it just expanded from there to about 2 more dealers by the time I came on board 16 years ago. And then I said, well, if this is working so well, why are we limiting ourselves to 2 or 3 dealerships? And so we hired a full-time, his title is business development manager, but really he's in charge of this auto loan network, and he vets dealers on a regular basis. He goes to the 25 dealers in the network weekly and visits everybody and just makes sure everything's good on their lot and all's looking good. And yeah, we have a full-time person dedicated to vetting dealers, bringing them on. There are times where we have more dealers than we want to bring on in a shot that we have to kind of pause for a while.
And that's a key there. I mean, this happens, you see it at credit unions with compliance, with lending side. You got to staff for what you want to have happen. So you having that full-time person, brilliant.
Yeah, that is a big challenge. And again, we could have a bunch of podcasts if you'd like, but that's a great point, that a lot of credit unions and people that I talk to and people in my network of people here in New Jersey, we talk about all the different ideas out there, but you've got to have the people to do it. So you've either got to commit to the investment of the right people to do it, or you're going to launch something that is inevitably going to be a problem.
Absolutely, 100%. Yeah, let's do an episode about staffing. I want to ask about what you are keeping an eye on as it concerns auto lending right now.
Values of cars are always being monitored. We're always, making sure that the values aren't taking off. We always monitor the competition, and then to see what's going on. We want to be competitive, offer a good rate. Not to sound corny, but we do want to do the credit union thing, which is help people. So the goal is not to give them the highest rate possible that is just below market. It's to have a really good rate that can keep people's payments affordable, and we can do the right thing. And then, of course, the biggest concern, though, especially in the subprime space, is always going to be delinquencies and charge-offs in a market where we're seeing upticks in delinquencies, not just in auto loans, but in credit cards and unsecured loans, et cetera. I mean, the whole world's delinquency and charge-off rate is going up. And so that's always a key part, to make sure that your collateral values are there, so that if there is a rise in charge-offs, that you're not going to experience painful losses.
Yeah, our lending reporter in the previous episode, he's saying delinquencies, that's his main focus right now.
Yeah.
In the data that we're getting. So what worries you, or on the flip side, what makes you excited about the marketplace as it is right now?
What makes me excited is the fact that we've got a really great captive audience with the people that we're working with, and the communities we're in. People know us in those communities, and we love that. And so there's always going to be some foot traffic. There's going to be ups and downs, like there is for any part of this business and part of the auto loan business. There's going to be ups and downs, but we've got people in that community that know Garden Savings and know those dealerships. And so we're always going to have some kind of a flow there. What concerns me probably is, again, the delinquencies. What I have my eye on the most is, are people eventually going to have payments that, because of pandemic money and things like that were affordable 18 months ago, are now going to put a greater strain on their wallet every week and cause some potential issues on paying back. So we've got to keep an eye on everything to do with the marketplace when it comes to that.
Yeah, the inflation, the student lending issue, everything kind of coming to a head in 2023.
Yeah, there's going to be less money out there, regardless of what happens with the Fed rates. We're already seeing it, right? I mean, every credit union I talk to has got some sort of liquidity or deposit issue going on right now. Some more pronounced than others, obviously, but everybody's got some kind of talk on that, which means there's less money, and it's because people are using their standard savings and checking accounts to pay bills that they didn't have to 2, 3 years ago when there was a lot of pandemic money flying around. So there is going to be a shift there. And that's why it's so important to monitor what is going on with repayment of loans.
So are you bracing yourself for that?
Yeah, it's very interesting. This is the time of year, January, that we build out our corporate goals and everything. So it's very interesting to try and build out goals that are aggressive and achievable. And yet we kind of know some of these numbers are going to change. The question is going to be when, because last year that people were predicting a lot of delinquency increases by Q2. And really, we didn't start to see those pains until the beginning of Q4. And so you've got to come up with a goal that's aggressive and challenging as far as where you're at with that. But it's also got to be realistic in that the world around us, the numbers are going up now. And so your numbers, you always want to set goals where your numbers are better than the year before. And this might be the rare exception where the numbers that are your goals might be status quo this year.
Oh, that's interesting. Thank you for sharing that. That's very interesting. So kind of final big question here. What does your 2024 auto lending future look like right now?
I think it's going to be good, solid. We had our best year ever in 2023 as far as our auto lending goes between our dealership network and the refinances we saw. I think it'll come down a little bit because I think there was a big run on those refinances of hybrids and Teslas. So I think it'll come down a little bit on the new vehicles, but I think the used autos will be pretty steady. The best time to ask me if that's holding true is March, April, May, June, when we see a tick. January, February are always slower for car loans for us. So March, April, May, June are when our dealerships really, really thrive. And so if our numbers are way low then I'll start to say, what's going on here? But I don't anticipate that. Again, our business development manager is in regular contact with the dealers. He has constant communications with them. And while volume is slower right now, and they're all saying, volume's slow, that is typical of January and February. I won't raise an eyebrow until it's March through June and they start saying the same.
Yeah, we just saw the numbers. We were talking about Jim and I, our lending reporter, for September and October. First time we had a 2-month auto lending decline in a row since before the pandemic.
Yep. And we didn't really see that. Yeah. So that was good for us. We didn't see that decline in September, October. We stayed steady this year. We're hoping for more steady next year.
Good to hear. Okay. Moving on to kind of a different segment here. I want to speak Michael to Michael with you for a moment. Do you feel like there are too many people named Michael in the world?
No, actually,
Really?
I love my name. I've always enjoyed the name Michael, and the more the merrier. For a small royalty fee, I'd be more than happy to share it with as many people.
That's a great idea.
Yeah.
Okay. Yeah. Growing up, you would have like 3 kids in the class named Michael.
Oh, I know. Always the case. Always the case.
Worst. So, second question: what's the best and worst thing about New Jersey?
Best thing would be a toss-up between the beaches and the pork roll, and it is pork roll, not Taylor ham. And then the worst thing, I work 40 miles from my job, and it takes me about 70 minutes each way to commute. So the traffic would hands down be number one on the what's not. Yeah.
My gosh. My commute is from my bed to the office.
Nice. Very nice.
What's the last movie you watched?
The Killer on Netflix. It was a Netflix movie. I watched that. I thought it was a little slow moving, but pretty good. I enjoyed it. And I'm watching The Bear. If we're getting into series, I'm watching The Bear on Netflix now too. That I'm enjoying. My wife likes that show as well. Yeah, The Killer was good, slow moving, but then it picked up a little bit toward the end. I liked it. Yeah.
Michael Fassbender looked fantastic in that movie.
Yeah. No, he was quite an interesting character too.
It was good. I enjoyed it. And The Bear. Yeah, I need to watch that one too. Okay, last question. What was the first album you ever bought?
Well, I was about, 8 or 9 years old when Kiss was huge, and I believe Kiss Destroyer was the first album I ever bought. So I think Kiss Destroyer would have that. And,
oh my God.
I had a metal phase for a while, and then I was
so
retro
good.
60s and was into the Doors for a while. Now I'm kind of an alternative country kind of guy. I'm all over the place. I do love music, though, and like a lot of different genres.
I love it, love it, love it. Ladies and gentlemen, that's Michael Powers, President and CEO of Garden Savings Federal Credit Union. Thank you, Michael, for sharing your time and knowledge with us today.
I appreciate you having me on and enjoyed doing the podcast. Have a great 2024.
Oh, yeah. We're going to do this again, Michael.
All right.
So This episode has been sponsored by Cox Automotive. Check them out online or on their socials. Please subscribe to Shared Accounts with CU Times anywhere you get or listen to your podcasts. Apple, Google, Amazon. You know how it works. And if you want to rate us, that would be great. We love your feedback. For those of you with questions or comments, please feel free to email me over at mogden@cutimes.com. Thank you to our producer, Jeff Metz. Please join us next week when we get into credit union auto leasing. I promise it'll be much more interesting than what that sounds like. Leasing, I love it. Some hate it. Until then, thanks for listening.